Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting companies through the ultimate stress test. I'm your lead analyst. Today, we've got a titan in our sights, Cadence Design Systems. Now, this company is right at the molten core of the AI revolution, no doubt about it. But the stock is trading at a valuation that doesn't just ask for perfection, it demands it. And with me, as always, is our market skeptic, who's here to tap the hammer and listen for cracks. The big question for us today is pretty straightforward. Is Cadence a true AI juggernaut, built on a foundation of solid steel? Or is it a high-priced trap, just waiting for the first tremor to send the whole thing crashing down? All right, let's get to work.
Okay, let's just dive right in. And you always got to start with the view from the top, right? From the corner office. This is the CEO, Anirudh's Devgan. You can practically feel the confidence just pouring off this statement. Look at the language he's using. He doesn't say helpful or important. He says essential. He's telling the market, we are the bedrock. We are the company that provides the fundamental blueprints for every single AI chip that gets made. You know, this is the classic picks and shovels play in the middle of a gold rush. The story is powerful. It says that if you believe in the future of AI, and who doesn't right now, then you pretty much have to believe in the companies that are building the tools to make it all happen. This quote right here, this is the entire bull case, boiled down into one sentence. It's the foundation of their entire story.
So here's how we're going to break this all down today. This is our blueprint. First up, we're going to inspect the business itself. Is it really built on AI steel, or is there some rust? Then we'll do what we do best. We are going to forge the financials, putting their raw numbers into the fire to see what comes out. After that, our skeptic here is going to take a hard look at that premium price tag. From there, we have to zoom out because it's a huge external risk we need to talk about, a new regulatory blueprint from the Department of Justice that's changing the game for a lot of companies. We'll show you how to navigate that minefield. And finally, we bring it all together for the iron verdict. Let's get into it.
All right, market skeptic here. So the company calls itself a leader. The bulls, they'll tell you this is the steel frame holding up the entire AI skyscraper. But you know, every skyscraper looks unbreakable from a mile away. My job is to get up close, put on the hard hat, and actually check the welds. Is this foundation really as solid as they claim it is? Or are we just looking at a beautiful, shiny facade that can't actually support the massive weight of its own valuation? Let's get in there and inspect the actual components of this machine.
Okay, now this is where it gets really interesting, because it's not just about one thing working. Take a look at the composition of this growth. This isn't just one engine firing on a single cylinder. This is a diversified, high-performance machine firing on all of them. Their core EDA, that's electronic design automation, their bread and butter, grew a really solid 13%. That's the bedrock, right? System design, same story, up 13%. Strong, stable growth. But the real story, the place where they're doing the really heavy lifting, is in two other areas. Look at hardware, a record year. They added over 30 new customers, and we're talking about the biggest players in the world buying up their Palladium and Protium systems. That is the AI infrastructure build-out happening in real time. And then there's the IP business, intellectual property. That thing grew nearly 25% year over year. And that is absolutely crucial because as chips get more complex, companies are licensing these pre-built blocks of IP. This tells you Cadence isn't just a software company anymore. They're a full-stack solutions provider for the most complicated engineering problems on the entire planet.
All right, let's see how that slick business model actually translates into the hard data. We've seen the parts, now we forge the financials. As lead analysts, this is my favorite part. We're going to take their Q4 2025 earnings report and we're going to throw it into the fire to see what it's really made of. The bulls will tell you this thing is a fortress of numbers. Let's see if it can actually hold up under some real pressure. I'm going to run through these key metrics fast, so try and keep up.
First thing you see, the top line for the fourth quarter, $1.44 billion. That's a solid, clean beat over what the analysts on the street were expecting. This is the first heavy block in the foundation. It's a strong signal of demand and, just as importantly, execution. But look, one quarter doesn't build you a fortress. It's just a single data point. What about the trend? What's the bigger picture look like?
And here's the answer. This is the consistency we're looking for. 14% revenue growth for the entire year. This proves that Q4 number wasn't some kind of fluke or a one-time pull-in. What we're seeing here is sustained double-digit growth at a massive scale. You have to remember, this is a multi-billion-dollar company that is still growing like it's a much smaller, nimbler operation. This is exactly the kind of momentum that gets institutional investors really excited, and it's what they'll point to in order to justify that premium valuation we're going to talk about in a minute.
So if you want to talk about a fortress, this is it. This is the number, $7.8 billion in a record-breaking year-end backlog.
Think about what that means. This is future revenue that is already locked in. It's under contract. This gives the business incredible visibility and stability moving forward. This isn't just hope or some rosy speculation about future AI demand. No, this is concrete contractual obligation. In fact, management has said that they expect $3.8 billion of this, nearly half, to convert directly to revenue in the next 12 months alone. This backlog, this is the steel reinforcement, the rebar, running through the entire concrete structure. It's incredibly strong.
Okay, let's put it all together on one slide so you can see the whole dashboard. This is a well-oiled machine. Just look at these metrics, moving in perfect sync. Revenue, up 14%. That's impressive on its own. But now look at the non-GAAP operating margin. It expanded by 210 basis points to almost 45%. That's the key. They aren't just growing, they're getting more profitable as they grow. That's a sign of incredible operational excellence. And of course, it all flows right down to the bottom line. Non-GAAP earnings per share grew a massive 20%. So you have growth, you have expanding profitability, and you have a huge earnings beat. From a purely financial standpoint, this company is absolutely firing on all cylinders. The frame looks incredibly strong.
Okay, the numbers are strong. As the market skeptic, I have to concede that. The fortress is well built, I'll give you that. But it's being priced like it's a palace made of solid gold. And that's where the problem starts. The real question for any investor today is this: has the market already priced in not just the stellar performance we just saw, but years and years of flawless execution to come? Because when you pay a premium price tag like this, you're not paying for the past. You're making a bet on a perfect, flawless future. And in this market, let me tell you, perfection is a very, very dangerous bet to make.
Let's put some hard numbers behind that premium I'm talking about. This slide, well, it lays it out in stark black and white. Cadence is trading at a trailing 12-month price-to-earnings ratio of nearly 77. 77! Now what about the broader software sector average? It's sitting at around 35. So let's be crystal clear. You are paying more than double for a share of Cadence than you would for the average software company. Now I know what the bulls are screaming at their screens right now, but it's not an average company. And you know what? They're right, it's not. But a valuation this high, this stretched, it leaves zero, absolutely zero room for error. A single misstep, one slightly disappointing earnings call, any tiny hint of a slowdown, and a stock like this could get cut in half, or worse. This isn't just a premium. This is a valuation that is priced for absolute perfection, and that introduces a massive risk all on its own.
And speaking of risks, sometimes you don't even have to look very hard for them. They're right there, buried in plain sight, in the company's own 8K filing. Now this is usually the boilerplate risk factors section that every company has, but this one sentence just jumps off the page. They specifically mention ongoing compliance, cooperation, audit, and other obligations that stem from a settlement they had back in July 2025 with the Department of Justice. Now listen, this isn't some historical event that's over and done with. The key word here, the one that should get your attention, is ongoing. That's critical. It signals a lingering regulatory cloud, an overhang, and in today's environment, you absolutely cannot ignore a signal like that. This is the first real crack we found in the armor, and it leads us directly to a much bigger, much more unpredictable macro-level risk.
Right. And that mention of the DOJ isn't just some little Cadence-specific issue. It's actually a symptom of a much larger, seismic shift happening under our feet. To really understand the risk that's priced into a high-multiple stock like Cadence, you have to understand that the ground itself is moving. The Department of Justice is operating under a completely new enforcement philosophy. For a company like Cadence, with a global footprint dealing with sensitive technology, understanding this new regulatory blueprint is no longer optional. It's absolutely essential for assessing the real risks here.
So what does this all mean for us as investors? Well, legal experts who've analyzed this have boiled the DOJ's new approach down to 3 core principles. First, focus. They're going to prioritize fewer, higher-impact areas. Think national security, trade, healthcare fraud. Second, fairness. They want to create more predictable, more certain paths for companies that cooperate to get credit for it. And third, efficiency. They're actually starting to consider the impact on the business itself, not just on deterrence. It's a fundamental shift from a broad, shotgun style of enforcement to a much more surgical, targeted approach. It's a whole new rulebook for the game. And that new rulebook, well, it creates a minefield. The risks are still absolutely there, but now the DOJ is sending very clear signals about where the safe paths are located. For a global tech company like Cadence, knowing how to navigate these new paths to leniency isn't just good corporate governance, it's a critical part of risk management that flows directly to the bottom line,
and therefore directly to shareholder value. So let's take a look at the map they've given us.
Now, this flowchart from the DOJ might look a little complex, but the message for us as investors is actually pretty simple. The path to the best possible outcome, that's the one there in green. It starts with one thing and one thing only: voluntary self-reporting. Companies that discover a problem, come clean about it immediately, cooperate fully with the investigation, and then fix the underlying problem, they are now being offered a very clear path to avoiding prosecution altogether. For a company like Cadence, which already has a past settlement on the books, knowing these new rules is critical. Any failure to navigate this process correctly could easily lead them down those yellow or red paths, which could result in massive fines and penalties that would absolutely hammer the stock price. The stakes here are incredibly high.
So let's be really clear about what this shift actually means and what it doesn't. What has changed? Yes, there are now much stronger incentives for companies to self-disclose and cooperate. They're dangling a bigger carrot. But what has not changed is maybe even more important. Individual accountability for executives is still a central pillar. And for the most serious cases of corporate misconduct, guilty pleas are still the dominant outcome. The big takeaway for a premium price stock like Cadence is that while the rules for cooperating are getting clearer, the fundamental hammer of enforcement is still very much there, and it represents a real and persistent risk to that perfect growth story the market has bought into. And just look at these priorities. For a company like Cadence, which operates a global supply chain and deals in cutting-edge technology at the very heart of the semiconductor industry, at least two of these are direct hits. You've got trade and customs fraud, that's a big one. And even more importantly, you have national security offenses. This is not some theoretical risk. This is a direct map of where the DOJ is focusing its time, its money, and its resources. And it puts companies in this exact sector squarely in the regulatory crosshairs.
Okay. Let's bring it all back home. We started this by examining the steel frame of Cadence's business. We looked at its financials, and frankly, it looks incredibly strong. But then we zoomed out. We mapped this new seismic zone of regulatory risk that's being created by the DOJ, a risk that, as we just saw, is particularly acute for a company like this. So now it's time for the final stress test. How does that incredibly strong frame hold up when the very ground beneath it is shifting? Is Cadence a genuine opportunity, or is it a high-price trap just waiting for the next tremor? It is time for the iron verdict.
So this is it. This is the moment of truth. We've laid out the bull case, and it's built on a foundation of truly incredible financial performance and undeniable AI momentum. But we've also laid out the bear case, and that's centered on a dangerous, sky-high valuation and a complex, shifting regulatory environment that this company sits right in the middle of. We've run the numbers, we've analyzed the external risks. So, after putting this company through our comprehensive stress test, what is the final call on Cadence Design Systems?
Here's the final analysis, boiled down to the two opposing arguments. I'll take the bull case, what we've been calling the steel frame. And it is powerful. You have a dominant AI-driven product portfolio that is truly essential to the biggest and most important tech companies in the world. You have a record $7.8 billion backlog that provides a fortress of stability and visibility. You've got jaw-dropping financial performance, 14% revenue growth paired with nearly 45% operating margins. And on top of all that, you have strong guidance looking out into 2026. This is the textbook case for a best-in-class company firing on all cylinders. And I'll take the bear case, what we're calling the seismic zone. It starts and it ends with that extreme valuation. A 76 times PE ratio leaves absolutely no margin for safety, no room for error. Then, you have the specific regulatory overhang from that 2025 DOJ settlement. It's not speculation. It's a known risk factor the company itself has flagged as ongoing. And finally, you have the broader uncertainty created by this shifting enforcement landscape, which puts a company just like Cadence directly under the microscope. Any global tech company is now operating in a completely new world of risk, and it's not at all clear that the market is fully pricing that new reality in yet.
So, we end with this final thought. The evidence we've laid out today clearly shows that Cadence has a foundation made of steel. The numbers are undeniable. The company's strategic position in the AI ecosystem is incredibly strong. But that's not the only question you should be asking yourself. The bigger question, the one that extends far beyond just this one stock, is this. Is your portfolio prepared for the seismic shift in regulatory risk that is happening across the entire market? Cadence is just one very clear example of a great company facing a complex new world. So the final verdict isn't just about whether you should buy this one stock. It's a challenge to you to reevaluate every single company you own through this new critical lens of risk. Because that is how you forge a truly stronger portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.